Hello, and welcome back to the channel. It is Tuesday, December 23rd, 2025, and if you were hoping for a quiet, gentle slide into the Christmas holiday, well, the market has some very different plans for us. The single most important story on my desk today is the aggressive tug-of-war we're seeing between a genuinely booming economy and a very nervous bond market. On one side, you have the stock traders trying to ignite that famous Santa Claus rally, pushing for those festive year-end gains. On the other side, the bond market is waving a huge red flag, with yields spiking to multi-month highs. So, why does this matter to you and your wallet? We are in a classic good news is bad news scenario. The strong economic data that just came out is fantastic on the surface, but it might just force the Federal Reserve to keep interest rates higher for much longer than anyone anticipated. Today, we're watching to see if the stock market bulls can maintain their momentum, or if the sheer gravity of higher bond yields will pull those equity valuations back down to earth before the year is out. It's a high-stakes game. Let's get straight to the numbers and build out our dashboard for the day. First, let's look at the major indices, which are showing some pretty impressive resilience so far. The S&P 500 has climbed about 15 points, now trading right around the 6,894 level. The Dow Jones Industrial Average is pushing even deeper into record territory, sitting comfortably near 48,436. And not to be left out, the tech-heavy Nasdaq Composite is also in the green, up roughly 56 points, trading at 23,485. So, on the surface, everything looks pretty good. However, the real friction, the real battle, is happening in the commodities and bond markets. The 10-year Treasury Yield, which is a key benchmark for borrowing costs across the economy, has ticked up to 4.19%. This rising rate environment acts like a speed limit on risk assets like stocks. It makes it more expensive for companies to borrow and expand, and it gives investors a safer place to park their money for a decent return. Yet despite this headwind, we are seeing a massive, and I mean massive, move in precious metals. Gold is trading firmly at an incredible $4,488 an ounce. It's acting as the ultimate hedge against sticky inflation, which just won't seem to go away. But the real standout performer today is silver. It has absolutely exploded, blasting to a historic new high above $70 an ounce. This isn't just about fear. This is driven by massive, undeniable industrial demand, which we'll dive into in a moment. In the energy pits, things are a bit calmer. West Texas Intermediate crude oil is trading down a bit, at $57.86 a barrel. This suggests that even with high demand from a strong economy, supply chains might finally be loosening up, giving us a little relief at the pump. Finally, let's check in on the crypto markets. Bitcoin is taking a well-deserved breather today. After a really strong run earlier this quarter, we're seeing prices consolidate. It seems like some of that speculative capital is rotating out of crypto and into the explosive breakout we're witnessing in silver and gold. Traders are chasing the hot hand. Now, let's go deeper and break down the top 3 stories that are really driving all this action today. First, we have to talk about the mechanics of this Santa Claus rally. What is it, and will it actually happen this year? Historically, the last 5 trading days of the year and the first 2 of the new year produce positive returns for the stock market roughly 79% of the time. We are technically right in the middle of that window as we speak. The common theory is that low trading volume, with many professionals on vacation, combined with a general sense of holiday optimism, tends to drive prices higher. It's a seasonal pattern that traders have relied on for decades. However, this year is unique. The bond market is actively fighting back. With that 10-year yield pushing toward 4.2%, borrowing costs remain elevated for everyone. This puts a real damper on the festive mood. Right now, investors are placing a big bet. They are betting that powerful forces like corporate stock buybacks and window dressing, where fund managers buy up winning stocks to make their portfolios look better at year-end, will be strong enough to overpower the immense pressure coming from the bond market. It's a fascinating test of wills. Will holiday cheer win out, or will the hard math of interest rates prevail? We'll know in about a week. The second major story you need to know about is the absolute blockbuster GDP report that was released this morning. The US economy grew at an annualized rate of 4.3% in the third quarter. To put that in perspective, that smashed all expectations. This is the very definition of economic resilience. Consumer spending is surging, and businesses are investing heavily in new equipment and expansion. On one hand, this is fantastic news for corporate earnings and, by extension, for the stock market. Healthy companies make more money. But on the other hand, it complicates the picture for the Federal Reserve. A rapidly growing economy like this very rarely requires aggressive interest rate cuts. In fact, it's the opposite. The Fed's main job is to keep inflation in check, and a hot economy can fuel price pressures. The market is now quickly repricing its expectations. The new consensus is that interest rates will likely stay steady, right where they are, well into 2026. The dream of a quick return to cheap money is fading. For investors, this means the game has changed. You need to focus on companies with real, tangible cash flow and strong balance sheets. The era of easy, cheap debt propping up unprofitable companies is not coming back anytime soon. Quality matters more than ever now. Our third and final story for today is what I am calling the industrial supercycle that is driving the incredible rally in silver and gold. Now, gold is often seen as a fear trade, something you buy when you're worried about the economy or geopolitical instability. And while there's an element of that, what we're seeing today is largely an industrial story, especially for silver. The breakout in silver to over $70 an ounce is not just speculation. It's being driven by critical shortages in the physical supply chain. Think about it. Silver is a key component in electronics, solar panels, and the advanced hardware needed for artificial intelligence. In fact, after oil, silver is the second most used commodity in all of industry. With the global manufacturing sector heating up and demand for green energy and AI technology exploding, there simply isn't enough physical metal to go around. This is a fundamental supply and demand imbalance. It's not a story about financial markets. It's a story about the real world needing a physical product that is becoming scarcer by the day. This dynamic could support these historically high prices for months, if not years, to come. So, what should you be looking ahead to tomorrow? Keep a very close eye on the trading volume levels. As we get closer and closer to Christmas Eve, volume will continue to dry up. This thin trading environment can sometimes lead to erratic and exaggerated price moves, both up and down. A single large order can have an outsized impact on the market, so be prepared for potential volatility on low volume. And that is your financial state of play for Tuesday, December 23rd, 2025. The economy is running hot, the markets are moving fast, and the battle between stocks and bonds is reaching a fever pitch. Thank you so much for joining me for this deep dive. If you found any value in this briefing and want to stay ahead of the markets, make sure to hit that subscribe button and turn on your notifications so you don't miss the next update. I appreciate you being here, and I'll see you in the next one.